The housing market ready to collapse? The housing market is in a bubble that is ready to pop. Ever since 1994, the median home price has increased by 181% while wages have only gone up by 66%. With the cost of living increasing and wages staying stagnant, something has to give. In addition, the housing market has been heavily supported by easier credit and low interest rates. If a recession were to occur, interest rates would skyrocket and prices for homes could plummet. What is the housing market? The housing market is the market in which houses or other residences are bought and sold. It is usually taken to include both the real estate market and the mortgage market. The housing market is the market in which houses or other properties are bought and sold. It is usually considered to be a sub-market of the real estate market. The housing market can be affected by many factors, such as the state of the economy, interest rates, inflation, and population growth. When the housing market is strong, prices for houses tend to go up, and when the housing market is weak, prices for houses tend to go down. Why is it in trouble? The housing market is in trouble because there are too many houses on the market and not enough buyers. This has caused prices to drop and many people to lose their homes. The housing market is also in trouble because of the subprime mortgage crisis. This is when people with bad credit were given loans that they could not afford and then defaulted on them. This has caused a lot of banks to go out of business and has made it difficult for people to get loans. There are a number of reasons why the housing market is in trouble and on the verge of collapse. One reason is that there is a huge oversupply of homes on the market. This has driven prices down and made it difficult for people to sell their homes. Another reason is that interest rates have been rising, which makes it more expensive for people to buy homes. Lastly, there are concerns about the economy and whether or not we are heading into a recession. How can you predict a collapse? The housing market is a very complex system and there are many factors that go into predicting whether or not it will collapse. However, there are some key indicators that can give us a good idea of whether or not the housing market is heading for a collapse. One indicator is the rate of home price appreciation. If prices are rising too quickly, it could be a sign that the market is getting ahead of itself and is due for a correction. Another indicator is the affordability of homes. If prices are rising faster than incomes, then it becomes increasingly difficult for people to buy homes, which could lead to a decrease in demand and eventually, prices falling. Of course, these are just two of many indicators that economists look at when trying to predict the health of the housing market. So, while we can't say for certain that the housing market is ready to collapse, we can say that there are some warning signs that we should be aware of. There are many factors that can contribute to the collapse of the housing market. For example, if there is a decrease in the demand for housing, this can lead to a decrease in prices and eventually a collapse. Another factor that can contribute to a housing market collapse is an increase in interest rates. This can make it more difficult for people to afford their mortgage payments and lead to defaults and foreclosures. Additionally, if there is overbuilding in the housing market, this can also lead to a decrease in prices and a market collapse. Consequences of a housing market collapse. A housing market collapse can have a ripple effect on the economy. It can cause job losses, financial hardship for families, and a decrease in consumer spending. A collapse can also lead to an increase in foreclosures and homelessness. A housing market collapse can have a domino effect on the rest of the economy. A drop in home prices can lead to a decrease in consumer spending, which can then lead to layoffs and a decrease in production. This can then lead to a decrease in demand for goods and services, which can lead to more layoffs and a further decrease in production. This downward spiral can eventually lead to a recession. There are a number of factors that can trigger a housing market collapse. A sudden increase in interest rates, for example, can make it difficult for people to afford their mortgage payments. This can lead to an increase in foreclosures, which can then lower home prices even further. Another factor that can trigger a housing market collapse is a decrease in demand for housing. This can be caused by a change in demographics, such as an aging population, or by an economic downturn that leads people to cut back on their spending. Thanks for watching. See you on the next episode.